Apple and Tesla. Which is a better long-term investment? Apple and Tesla are arguably two giants in the tech space. Tech enthusiasts often wonder which of the two makes a better long-term investment. You definitely don't want to miss this analysis. Several years ago, during a Q3 2022 earnings call, Tesla CEO Elon Musk said, "I thought it was possible for Tesla to be worth more than Apple, which was then the highest cap company in the market." But which of these two companies would be the better investment? Tesla and Apple have very little in common, except for the fact that both stocks are top 10 holdings in the Nasdaq Composite and have been exceptional investments over the past decade. However, while Apple stock held up better than the Nasdaq in 2022, Tesla stock has been severely hit, down 73% in the past year. Timing the purchase of Apple stock well could have produced gains of over 370,000% between 1982 and now. In other words, an inflation-adjusted investment of about $3,000 back then would be worth around $1.1 million today. Over such a long period, around 40 years, it's hard to find another stock worthy of dethroning Apple as the wealth-producing king of our generation. That said, Tesla stock has been equally impressive in producing astonishing returns, albeit over a shorter time frame since the EV company became publicly traded in 2010. Shares of Tesla have appreciated a whopping 9,330% over the past 12 years. Comparing the performances of Apple and Tesla isn't entirely fair, as the latter has turned a nominal initial investment of $1,000 into $94,000 today, whereas Apple investors would have ended up with $17,000. Historically, Tesla has been the better growth stock, which is also evident in how much more volatile and susceptible to large drops it has been compared to Apple stock. It is important to note that a key trait of growth stocks is both high risk and high reward. For example, Tesla's annualized volatility since 2010 has been 63% versus Apple's 28%. Tesla's worst drop from a peak since 2010 has been 61%, compared to Apple's 40%. Still, experts believe that Tesla is going to outperform Apple over the next 5 to 10 years. So, when it comes to which is the better buy, it would be Tesla. However, Tesla is a far more volatile, risky, and stressful investment, making it a stock that's probably best avoided if you don't want to deal with the drama. If you have a shorter time horizon or a lower risk tolerance, this is especially true. What makes Tesla such an exciting stock right now is that its fundamentals are finally catching up with its stock price. The argument that Tesla is being priced for what it could become far into the future isn't as easy to make now that the stock has collapsed. Whether you love it or hate it, Tesla has undeniably grown to become a very good company. It boasts an industry-leading balance sheet, operating margin, top and bottom line growth, and free cash flow. With many of these strides made in the past 2 to 3 years in recent years, Tesla has become more consistent with its profitability while maintaining its rapid growth rate. For those who think Tesla is just a car company, production and deliveries would need to increase significantly to justify surpassing its previous all-time high. However, if you believe Tesla can monetize its electric semi-truck, robotics, and autonomous driving technology, and expand its renewable energy business, it could evolve into a company with a much higher valuation, akin to Microsoft's transformation. Overall, the risk-reward ratio for Tesla appears favorable at these levels, but investors must be prepared for a volatile journey. On the other hand, some experts argue that Apple has a better valuation. The recent sell-off has pushed Apple shares below the $2 trillion mark for the first time in nearly 2 years, bringing its market capitalization to the same level it was at in August 2020. After losing 1/3 of its value in the past year, many believe now is a good time to buy Apple shares. Recent concerns include a drop in shipments of the new iPhone 14 Pro due to manufacturing struggles in China and potential lower demand as consumer spending slows in the current economic environment. These issues have led some analysts to lower their estimates for Apple for sales of iPads and Mac computers, adding to concerns about lower earnings. This scenario does add short-term risk to buying the stock now, but the Apple ecosystem remains a strong long-term business. The company generates significant cash flow and returns it to shareholders through both dividends and share repurchases. Over the past 5 years, these stock buybacks have reduced Apple's share count by more than 20%, giving existing shareholders a larger stake in the company. With Apple's recent stock price drop, it is now trading at a more attractive valuation based on its price-to-earnings (PV) ratio, which is at a level not seen in almost 3 years. Even if earnings growth stalls this year, a P/E ratio of around 20 represents a good entry point to own this proven company without the risks associated with less mature technology and growth companies. However, comparing Tesla, a relatively young company, against a far more established company like Apple may not be entirely fair. It might make more sense to contrast Tesla's performance over the past 12 years with the first 12 years of Apple as a public company, between 1980 and 1992. During that period, Apple returned a respectable 13% per year, meaning an initial investment of $1,000 would have grown to $4,385 in 12 years. In comparison, from 2010 to 2022, Tesla returned an astounding 43.8% per year. An initial investment of $1,000 in Tesla during this period would have grown significantly, highlighting Tesla's strong growth stock characteristics compared to Apple's historical performance of $1,000 would have grown to $94,000 in 12 years. It's worth noting that Apple did not have an easy start as a publicly traded company. In addition to facing a recession in the early 1980s and another in the early 1990s, Apple nearly went bankrupt at one point. The return of Steve Jobs as CEO and the launch of the original iPhone in 2007 were pivotal in turning the company's fortunes around. That said, historically, Tesla has demonstrated much more growth potential than Apple. However, investors tend to be forward-looking, so we should consider future growth opportunities as well. Apple could be seen as a growth company due to untapped opportunities in areas like mixed reality, the metaverse, and even autonomous electric vehicles, Tesla's wheelhouse. One must believe that these growth avenues could become game-changers for Apple. However, when considering its current product and services portfolio, it's challenging to see how smartphones and laptops will provide significant growth for Apple over the long term. On the other hand, it is probably easier to see the growth argument for Tesla. The company has been revolutionizing the automotive industry, pushing the boundaries of electric vehicle technology and production. According to Statista, sales of battery and plug-in hybrid EVs are expected to more than double between 2022 and 2027, with Tesla leading the industry. Beyond automotive sales, Tesla has other promising opportunities, including battery applications outside the automotive sector, driverless technology, and public transportation, such as the anticipated autonomous taxi service. Diving into the growth prospects, according to YCharts, sell-side analysts predict that Apple's EPS will continue to grow over the next 5 years, but only by an annualized rate of 11%. In contrast, off a much lower base, Tesla's EPS could climb by an annual rate of 29% over the same period, according to Wall Street. This clearly positions Tesla as more of a growth company than Apple, at least based on expected bottom-line trends. From a valuation perspective, Tesla justifies its growth stock status by trading at a forward P/E ratio of 26x, much lower than the approximate 100x of early 2022, following recent share price declines. Apple, on the other hand, commands a lower forward earnings ratio of 20x. While both Tesla and Apple could experience further declines, there are excellent reasons to consider owning either company now. Tesla and Apple are both well-equipped to handle a recession, even if it results in short-term margin compression and slower growth. Each company also offers a path toward multi-decade growth by expanding their core businesses and monetizing new investments. For Tesla, long-term growth involves expanding its electric vehicle offerings beyond passenger cars and generating revenue from software and robotics.